Vasco sampling. Spacing here is not great, but anyway, so this is tonight. I'm going to save this. I'm going to save this as tonight. People ask you, what did you learn in auditing 330? Forget doesn't know how to use a computer. Okay, let's go ahead and open up the chapter 1 and 2 handout from last week. And I want to talk about something. I'm going to go into a little bit more detail into this here. This the financial audits, we talked about this last week a little bit on page 2 near the end of class. These financial audits, this is what CPA firms do. CPA firms do financial audits. When you get your CPA exam license, it's a license to do what? It's a license to do financial audits. So this is what the CPA license is all about. And just like a car license allows you to drive a car, a CPA license allows you to do financial audits. It's actually a fairly narrow exam. I mean, it's not about making financial statements and all that kind of stuff. It's only about doing audits. So the CPA license allows you to do audits, and that's what when the state licenses you, that's what they are licensing you for, is to do these audits. Now, what I want to do though is open up an audit report, which I sent out in the email. I'm not sure if you got it yet. Let me see if I. If I didn't get it yet, that means you guys probably didn't get it. Oh, it's there. You should have it in your email. It looks like this. Is there anyone that did not get it? Okay. All right, so let me let's go back to it then. Get to our stuff over here. Okay. Don't worry about this right yet, but this is what they call a clean opinion. Their term for it is unqualified opinion. And unqualified just means that there's nothing wrong we can tell you about. We're not going to put any qualifications on. We're not going to say, except for this thing, it's unqualified. There's nothing bad. Also known as a clean opinion, standard report, or unmodified opinion. This is yeah. So anyway, so it's labeled what it is. Independent report. We make it generally to the shareholders and the board of directors. Now, you might be wondering why we don't make it to the management of the company. So let's give this company a name. Let's say that this is IBM. So what happens is IBM makes their own financial statements. The auditors do not make their financial statements, and there's a good reason why. I'll tell you in a second. But IBM makes their financial statements. Now, those financial statements, there could be errors on them, there could be fraud on them, there could be all kinds of things on them. So what happens is a CPA firm is paid to come in and audit those financial statements. That's where your license comes in. If you have a license, you can audit. If you don't have a license, you can't do that. So a licensed CPA, they'll pay a licensed CPA to come in and take a look at their financial statements. The auditors, again, do not make the financial statements. They don't change the financial statements. They simply do make a report on the financial statements. Now, if they come across something in their audit that's wrong, they'll tell their client, but IBM, they'd say to IBM, here, make this change, and hopefully IBM will do it. We'll talk about later what happens if the IBM doesn't do it. But the auditors, they actually do not ever change the financial statements. And here's why: they have to be unbiased. If they were to make those financial statements, they'd be biased. They made the financial statements, so they have to be unbiased, independent. They cannot make the financial statements, but their report will go along with the financial statements. So the report will go along with the financial statements. So this report that you see here, this is the report that will go along with the financial statements after they had their audit done. Okay, so this report of the independent auditing firm, it's sent to the shareholders and board of directors usually, because we don't send it to IBM management, because IBM management made the financial statements. They're the ones that made the financial statements. They don't need the audit report. People on the outside who don't know, they want to know if they can rely on these financial statements. So someone on the outside who does not know, I own stock in IBM. Obviously, just because you own stock in IBM doesn't mean you can walk through the door and look at their stuff. Someone else has to go in there and do that for you. So that's what the CPA firm does, and they have this report, and this report goes along with the financial statements. Okay, so the financial statements are IBM. IBM makes it. This report goes along with it too. I'm whistling for some reason. This report, it is again. This report goes along with it to let the reader know: can I rely on these financial statements? Are they okay? Is there anything I should know about these financial statements that's wrong? So again, it's directed to people who are not inside IBM. Okay, and this is a little bit different from in the past. The opinion on the financial statements, we put it right in up first. It used to come at the end, but everybody would just go to the end and look for it, so they put it right up front. And it basically says, we have audited. Make this a little bigger. Actually, I can bold this whole thing. It's a little funny, but okay. We've audited the balance sheet. Income statement. Comprehensive income statement, which is a new wacky one. So we just list out all the financial statements. So this financial statement 1. Two, income statement. 3, comprehensive income statement. Sometimes it's combined with number 2. Stockholders' equity. And cash flows. So, yeah, so sometimes these two are combined. Not always, but sometimes they are. Okay. And then it says down here, in our opinion, Financial statements present fairly in all material respects. We'll talk about this in a second. The financial position, which is just the balance sheet. Operating cash flows for the 3 years ending, blah, blah. Okay, now. Coming down here, basis for our opinion. You'll notice it says right off the bat. These financial statements are the responsibility of the company's management. So I'm going to stop right here for a second. The auditors are not responsible for the financial statements. No, somebody might say, well, the auditors didn't catch that. The auditors are not responsible for the financial statements. The company is. The company issues the financial statements. They're responsible. So then the question is, well, what are the auditors responsible for? That's the second one here. Our responsibility, this is the auditors. Oops. To express an opinion on the financial statements, and this is an important one based on our audit. So the only thing that we can base our opinion on is on our audit. It cannot be from anything else. So it can't be based on anyone else's audit, anyone else's work. It has to be based on our work, on our audit. That's what the opinion has to be based on. So the company, let's say IBM, they're responsible for their financial statements. So those financial statements they put out, they're responsible for it. The auditors are responsible for an opinion. Okay, so they're put an opinion on the financial statements. So these, financial statements good? Are they misstated? Are they misleading? What are they? So that's what the opinion is on those financial statements. So again, the auditors do not make the financial statements, and they don't change the financial statements. It's up to the company to do that. Okay, down here, we'll talk about this a little later. We talked about audits in compliance with the PCAOB, which we'll talk about in a second. Don't worry about that right now. This is probably the most important sentence in the whole thing. So important, I'm going to underline it and highlight it. Oops. Okay, those standards require that we plan to perform the audits to provide reasonable assurance. So only reasonable assurance. We do not offer absolute assurance. We don't say absolutely that these are, we offer reasonable assurance. What's reasonable? Maybe 95%, 99%, whatever it is. We offer reasonable assurance. So we do not offer absolute assurance. Reasonable. And then we also go a little bit further and say free of material misstatements. Whether it's due to errors or fraud. So whether it's fraud. Now, the important term there is material. Let's make that. We'll make that blue. So, do we look for all misstatements? Nope. We only look for misstatements that are material. So, let me ask you a question. We find a $5 million error on financial statements. Is it material? Anyone?
Yes.
It can be. It depends on something. It depends on the size of the company. You know, if you're talking about a company, well, it'd be like IBM, $5 million would not be material. You know, they make billions. And so you're talking about something that's less than a percentage even. In fact, $5 million may not even, if they have their, assets listed in thousands of millions and all that kind of stuff, it may not even be a tick on it. So it depends on the size of the company. A smaller company, $5 million, huge. Yeah, absolutely material. Very large company, take a Walmart, $5 million. No. And as an auditor, you won't even be looking for a $5 million error or a $5 million fraud if you're auditing Walmart. It's not material. So it really depends on the size of the company. The small companies, they have a much lower materiality. To them, it's a much bigger percentage. $5 million. If you take a company that has $20 million worth of revenues and they're off by 5 million, it's massive. Excuse me, for the issue. Well, it actually is. If you, I tell you, let's pull up a report. No, pull up a report. Let's see if I have it. I may have just said something I don't have. Audit report from. Here's an IBM annual report. Okay, so here's IBM's audit, 2019. This is what we're going over now. Let me show you their report though. Wait a minute, you can't see my screen. Let's try this again. Share my screen. Financial statement summary. Okay, so here is the consolidated balance sheet. This is for IBM 2019. And let's say that their assets were misstated by 5 million. So these numbers down here are in millions. So this is $155 billion. Put on the extra zeros in here. Okay, so this would be you gotta format it. Oh, here, I'll put a percentage. So it would be way less than 1%. It wouldn't be noticeable just because it's such a large number. Now, again, we're not saying that to someone who is committing a fraud, stealing $5 million or something like that is not material. And there are people in the company that will look for that. I used to do that actually. I was an internal auditor, and we definitely looked for fraud. We had fraud investigations fairly routinely. I had the unfortunate actually caught 2 people with fraud. It was ugly, but anyway, it really depends on the size of the company. $5 million, okay, to IBM's not material, but again, a smaller company, yeah, it could very well be material. Okay. And just so you know, I think I pulled it up when I didn't have my report showing, not showing. But this is the, you'll see that this is, the same thing that we're going through here. In our opinion, blah blah blah. Another kind of funny thing about audit reports. And that is this, that we always tell you not to plagiarize things, don't plagiarize, but when it comes to auditing, you're required to use that exact report. You have to use that language. If you don't use that language, you can actually lose your license. So unlike other things where they say, don't plagiarize, you have to plagiarize. If you're an auditor, that report is standardized. It has to be used if you're doing audits. So this is this isn't just someone's idea of it. This is exactly the one that you have to use. Okay. They talk a little bit about looking at risks. Another thing they said, procedures include examining on a test basis. Another very important word, set of words. Evidence regarding amounts and disclosures in the financial statements. Okay. Another thing about auditing is we don't always test 100%. Why don't we test 100%? Sometimes because it's not necessary. We can get 99% sure with a much smaller sample, and sometimes because it's impossible. If you were to, let's say you're going to audit the daily transactions of Walmart, you want to see if their sales are right. To audit, I don't know how many transactions they have. It's got to be in the billions. There's not enough auditors in the world to audit all the transactions that go through Walmart for the year. So that's pretty much impossible to do. So what we do is we take a lot of times it's statistical, like we do in the classical sampling thing we're doing, and we will use that to project over the entire populations. And a lot of times, with a lot fewer items than the entire sample, the entire population, you can get fairly accurate. A few hundred of them, a lot of times you can get to be 99% accurate as far as population as a whole. So again, reasonable assurance, not absolute assurance, because it's more efficient, A, and it's not necessary to do 100%, or B, it's completely impossible to do 100%. Okay. Critical matters. Critical matters are things that, well, they're critical. They're things that come up in the audit, and they're basically telling the reader if there's anything that they should pay attention to. And here's kind of the criteria. So there are some things that you might go through that are difficult to do, to actually wrap your arms around it and stuff like that. Let me see if they have any critical ones for IBM. I can't remember. Oh, they do. Let's actually look at some critical matter, huh? So here, this is from 2019, a report. And they said that there are income tax on certain tax positions. We don't need to go through the whole thing, but it looks like there's something with the tax positions that they're not completely certain about. Okay, and they said here that the unrecognized tax benefit were 8.6 billion, which is obviously material. These are in billions, not millions. So this is something they say, by the way, we're not sure about these income tax positions. So that would be a critical matter. Okay. So critical matter are those things that are you should want the reader to know. Okay, now coming down here, a few important things. We will have it that we are assigned by the audit firm, whoever the audit firm's name is, that'll be the signature. It'll say how long we've been on the audit. City, state, or country. And the date. Let me see if they have that on the I'm not sure if it was required. Oh, okay, so this is Price Waterhouse. And Price Waterhouse has served on the company's auditors since 1923. Okay. So they've been auditing that company for a while. Okay, so save this. Okay, so a few takeaways from this. Auditors look for things that are material. Small companies, we're looking for smaller things. Bigger companies, we're looking for bigger things. So it kind of goes along with the size of the company. Now, you'll find people who will think that auditors are looking for smaller things. Sometimes you hear somebody say, oh, this person was stealing, $50,000 a year for 10 years, and the auditors never caught it. Auditors probably weren't looking for it. Unless $50,000 is material. If it's material, there's a problem. But if it, someone's stealing $50,000 from Walmart, no way would they be looking for it. And by the way, it probably costs more than $50,000 to find it. If you're looking at the company as a whole, it would be a massive amount of work to look for $50,000 embezzlements. So anyway, again, it's one of those things that a lot of people don't understand, and that we will know very well, is that we look for things that are material. Things that will make a difference to the reader of the financial statements. Okay. Yeah. Okay, so we talked a little bit about the operational blah blah blah. Okay, so let's go down here. Okay, types of auditors. Okay, financial auditors. And these are CPAs. Those on page 3.
Professor, is it true that you must have your CPA to be an auditor? You just can't have your accounting degree with like certifications or fraud, like say if you had your fraud certification or something like that.
The CFE, the Certified Fraud Examiner, the examination, by the way, I encourage you guys can get that when you're still in school. And they had a pretty good deal on it. I'll look and see what the deal is. It used to be $300 for all the materials and for the testing, which is fantastic. $300 isn't even one section of the CPA thing. So anyway, yeah, the CFE is a fraud designation, and it's for looking at fraud. Now, fraud is a part of the overall auditing, window thing. So you can't do audits with a CFE. It's part of it. Looking at fraud is part of it, and financial statement fraud is part of it. But it is not a designation. It's not a license. It's a designation given by the I forgot the name of it now. The fraud examiner people. And well, let me put this on the screen. So we look for misstatements due to fraud or error, so fraud is part of it. But it's not the entire thing. So we look for we look for anything that's fraud or error in the financial statements. Now, having said that, for fraud examinations, the CFE is very well respected. I used to be a CFE, by the way. I let it go just because they wanted me to do all this extra work for they didn't count some of my my continuing education stuff. And I got 4 designations anyway. But anyway, but I did take it, did pass the exam. The CFE is certified fraud examiner, and it is it's looked on very well. And a lot of the stuff that we're going to talk about in here, some of the stuff anyways, does come out of that CFE exam, especially things related to more of the employee theft and that sort of thing. A lot of that comes out of the CFE. The external auditors, in general, we don't really look too much for employee fraud. It would have to be massive for some of the larger companies to have it material. You know, like I said, like I just use the example of IBM, $5 million. You know, how much would it take? How much fraud would they have to make it material? They have to be massive. So a lot of times you kind of don't even, isn't it? You don't look for employee fraud, theft, and all that. You're more looking for the big numbers that someone might be trying to cook the books and make the financial statements look better than they are, that sort of thing. So yeah, they're both in the same field. Auditing is just a little bit wider of a field that you're looking at for errors and other things. Okay. Oops. Oops. Okay, so financial auditors, CPAs. Governmental auditors. And especially at the federal government level, they're very specialized. You know, if they're auditing, say, the Pentagon, you know, how many Pentagons are there? There's only one. So they have their own set of rules, they have their own auditing standards and all that kind of stuff. Those are governmental auditor. The ones that you're somewhat familiar with are tax auditors. Probably what a lot of people think of when they think you're getting an audit. And one more that's kind of sometimes overlooked, it's a good one, though, is internal auditors. And when I did auditing, this is what I was. And internal auditors, these people may very well be certified fraud examiners. They can be certified internal auditors, which I am. There could be other things, certified managerial accountants. Now, these are generally not licenses. So the CPA exam, this is a license. And it's just like a driver's license. It's given by the state. You pass the test and you jump through the hoops, and it's a license. So the internal auditors, now you could have a CPA and be an internal auditor, but these are kind of the ones that a fraud examiner would certainly be an internal auditor. Certified internal auditor, certified managerial accountant, those could all be internal auditors. And internal auditors, just so you know, they're inside the company. Um. I was gonna sound a little bit, so. Digital auditors who work for IBM are paid by IBM, so they're inside the company. Just to give you I worked for Navistar, which they make trucks. And then I also worked for US Steel, which, you know, makes steel. But I worked as an internal auditor. I was inside those companies. And I worked for those companies. Now, I didn't do the audit for those companies. Even though I was a CPA, licensed CPA, I can't do the audit for them. Why? Because I'm biased. They're writing my paycheck. So it has to be somebody on the outside. That's what the CPA firms are. CPA firms are on the outside of the company. So if you're an internal auditor, you're inside the company. Now, as an internal auditor, as you can imagine, you know, internal auditors are there all year round. So they're there for an entire year. The external auditors may come in for, you know, 3 weeks. So who's going to know more about the company? The internal auditors or the external? The internal, they're going to know far more. Right? I mean, they're there every day. They're going to know, you know, little frauds, the big fraud, whatever it is, you know, any problems that we're having in inventory, all that kind of stuff. They know it way better than the external auditors, but they're not independent. And that's why they cannot write the audit report, because they are not independent. So even though, you know, the internal audit actually does a lot of stuff. In a lot of ways, it's more interesting than external auditing, because not only do you look at financial statement stuff, you look at everything. Literally, we did look at everything, you know. So I think it's more interesting, but it's only with one company. Okay, so the internal auditors are within the company, and this is where, if you're a fraud examiner, if you're working for one company, you'd probably be in there. It's possibly a fraud examiner outside of the company. You can do fraud examinations without a license. There's no license for it. For some things, you may have to have a lawyer involved to get subpoenas and all that. But you can be an external, you know, you can be outside the company and still be a certified fraud examiner. You just can't do the audits. Okay. AICPA, American Institute of Certified Public Accountants. Okay, this is a club, and the club only has CPAs as members. Now, you got this club. It is not a government agency. Even the N out government. Okay, so the AICPA, it's a club. When you pass the CPA exam, they'll send you a note in the mail. Hey, want to join our club? And you can join. You know, if they ask you, you can join. They only have CPAs from not a government agency. So you say, okay, well, why would I want to join that? What do they do? Okay, a few things that they do. They make the CPA exam It is used by every state. So they make the CPA exam. If you take the CPA exam, whatever state you take the CPA exam, it'll be the same CPA exam. Every state uses their exam. The states don't have to use their exam. They could make up their own, but they don't. They say, oh, by the way, there's this club. And you gotta take the exam made by this club. And that's what we're gonna use to determine whether you are worthy of a CPA license. So they make the exam that people that's used to license CPAs. Just put that in there. Second, you make the accounting rules. Oops. The generally accepted accounting principles, or we like to call it GAAP. So they make the accounting rules. You say, well, who cares? This is just a club. It's like the Boy Scouts, Girl Scouts, something like that. You know, why do I care that they made a bunch of accounting rules? Well, the reason why you care is that Securities and Exchange Commission, as well as the SEC. Securities and Exchange Commission. Companies. Also on companies too, not just whatever. So all publicly traded companies must use the AICPA's accounting rules. So again, AICPA, not a government agency, a bunch of CPAs. The AICPA, they make the CPA exam. Every state uses it. So, you know, their power does not come from their own power. It comes from basically somebody else. The state says you have to use that group's exam to become a CPA. Okay, same thing with the generally accepted accounting principles. They make all these accounting rules, and it's just a club. They can't make anybody do anything. You know, it's kind of like if the Boy Scouts said, "Okay, we made some accounting rules. Nothing to do with me, right?" Well, the AICPA and you know their rules, the SEC takes those rules and says, all companies, you must use this group's rules. So even though the AICPA doesn't have any power, the people that dictate how businesses run they say they have to, you know, that the all the publicly traded companies that they have to use their rules. So it isn't, you know, the AICPA isn't powerful in by themselves. They're very influential, but they're influential because of other groups that are government agencies. Okay. And third of all, I'm sorry. They make the auditing standards. And this is, oops, this is no. Doing crazy things here. This is known as GAS. And GAS stands for Generally Accepted Auditing Standards. Okay, so generally accepted auditing standards. These are the standards that they come out with, you know, for auditing. Again, they are just a club. So it's just a club. They make the auditing standards. And you say, okay, well, so what? Club makes auditing standards. I don't need to pay attention to that. Well, a lot of these standards become state laws. And also, much of the SEC's auditing standards come from the AICPA. This is a fucking gas. So again, the AICPA, no power, just a club. But because it's the state, because of the Securities and Exchange Commission, they have a lot of power. They're easily the most influential group in American accounting. Yeah. And again, they're just a club. Okay. Auditing Standard Board. Probably guessed they make the auditing standard. Okay, certified public accounting exam. We mentioned earlier. Made by the AICPA, not the state. Have you guys talked about the AICPA, the CPA exam in your other classes? Gone into it at all or no?
Not much.
Yeah, we touched, yeah, we did touch bases on those, the CPA.
They're changing it.
Yeah,
And it's gonna be a little bit different. It's basically, you're gonna have 3 standard sections of it that you pass, and then there's gonna be 1 section that you can use for other things. One will be for basically consulting, one will be for auditing, and one will be for taxes. So there's kind of a, you know, a choice. Having said that, the license will be exactly the same. And those extra, those optional, whatever those optional ones are, they do not give you any special powers. You know, so which is a little bit, I thought maybe like the tax one would, but nothing. So, and just so you know, so the license is still gonna be the same. The idea is that a lot of times people will go into public accounting and they don't always end up in audit. You know, for the last however many years they've had the CPA exam, it's always been on the audit. And you do have people who are on taxes, you have people who do consulting, you know, information systems and that kind of stuff. So it isn't all just one thing. And I think that, you know, they're kind of looking at the profession as a whole, maybe, which I think is probably a better thing. Anyway, the exam is changing quite a bit, though. It used to be 4 sections that were all, you know, everyone took all 4 sections, whereas now everyone takes 3 sections, and then there's you get an option for the last one, the 4th one. And by the way, you know, it's kind of funny, when I took the CPA exam, they used to have questions that were like that. So you'd go, you know, let's say you had 30 multiple choice questions, and they'd have, you know, 5 problems, but they'd say, you know, here's one at the end, and you can either do this one or that one. You know, they may have a tax question or a cash flow question, or whatever. But you didn't know that until you got into the exam. You know, then you run into that. But yeah, so they did have a little bit of that in the past, where you kind of, if you were kind of an expert in a different field, you know, you still pass the exam using that expertise, but now it's going to be a little more formal. Which you know, people are all up in arms about it, but I think it's probably, you know, it's a good way. And again, the licensing is exactly the same. And if you wanted to do it similar to what you did in the past, you would just take the auditing route. So, okay, maybe the CPA, there's 4 sections. There's still 4 parts to it. Passing rate. This is a little bit subjective, but it's around 75%. It's a little bit misleading, because what they'll do is they break up the questions into easier questions and harder questions, and the harder questions are given higher points. So you can actually answer 2 different questions. One will be worth 1 point, one will be worth 2 points. So they break them up that way. So it is possible that you get, you know, maybe you only answer 65% of it right, but get all 75 points because you got more of the tough questions right. So it is a little bit different. But basically, a good way to think about it is, you know, 75% pass rate. Okay, I think we'll other state boards of accountancy. Just to wrap up this, then we'll take a break. All these licensed CPAs and the State Board of Accountancy, they're the ones that do it. You must follow certain rules. Some were kind of obvious. No felonies, must pay your taxes. There are continuing education requirements. So these are all things, you know, these are things that you can lose your license for. losing your license is fairly rare, obviously. But anyway, all states, they all have their boards of accountancy and they all have, basically their rules. And something that's come about in the last 10 years or so is that there's a portability to your license. It used to be really hard to go from one state, not all states, but a lot of states, it was really hard to go from one state to another. They had different requirements for taking the exam. They had different requirements when it came to where you took the exam, residence and all that kind of stuff. For instance, Florida, it was almost impossible to transfer a CPA license into Florida. A lot of people retired, a lot of accountants retired down in Florida. And they didn't like CPAs coming in. So it was really hard. But nowadays, they're pretty much portable. And you can actually be licensed, you can have your license, transferred from one state to another. If they do have some different things, if they have like an ethics exam or something you get to do every year, as long as you do that, you're okay. You could actually be, if you pass your CPA exam, you could be licensed to licensed CPA in all 50 states. Now, the fees for that license are $300. So if you're not doing an audit in the state or something, you probably don't want to be a licensed CPA in all 50 states because you'd be paying out thousands and thousands of dollars for stuff that you don't need. But you can be licensed in 2 states. You can also transfer from one state. Like let's say you're in Illinois, you're going to move down to Mississippi. You go down to Mississippi, you can transfer it. Your license, you get licensed in Mississippi, you get CPA license, and then you can get rid of your license in Illinois. You don't have to have both of them. And if you move back to Illinois, same thing. Just get, have your license transferred to Illinois, get licensed in Illinois again and you practice in Illinois. So it is a lot easier nowadays than it was in the past. So, and then that's good, for especially if you're moving around. Okay, let's see here. Let's take a break. And I think when we come back, we'll do the we'll do some more work on the sampling. Hey, look, we'll use the same one from last time. So be back at 7:10. This is 11 minutes. Any questions on anything? Okay. All right. Well, we'll come back at 7:10 and see what we can get done on that. And obviously, we're not going to finish up the chapter 1 and 2 handout this week. Definitely finish it up next week, and then probably do the multiple choice questions, and the exam will be given out next week, and you'll have a week to do it. So, no exam this coming week, obviously, until we finish the handout. Okay. Oh, good question, Miracle. No, we'll, I'll back it up. I'll back up the time. It won't be due until at the earliest 16th. So no, nothing will be due this week. I'm not sure we'll finish the handout. We'll see. I got a little dog that senile. Trying to get it in. Oh, I know what I was gonna tell you. You know, working as an internal auditor, I did work with, fraud and that kind of stuff. And I remember working with the external auditors. A lot of times the external auditors will use the internal auditors to help them. We wouldn't make any decisions or anything, but we could do some of the testing and, they would make the determinations on the results and all that. Excuse me. But I found $100,000 error in cash at one of our, we owned an insurance company at Navistar. And I'm, hey, look what I found. I found $100,000 in cash. They bring it over to the in charge auditor. And I'll never forget this guy just looking at me like, okay, thanks. It didn't mean anything, because they're looking for bigger fish. But I was all excited. $100,000. Anyway, I told my the director of audit about it, and he's like, well, I should change that. So we actually did get it fixed, but it was kind of funny that the external auditors paid no attention to it. Okay. Oh, did we already do this one? Oh, we did. I'm sorry. You do all these? Oh. Yeah, okay. We should finish it. We should be able to finish one. Okay, so let's take a look at number 4. And again, 4 and 4 and 5. This is more like what you're going to see on the CPA exam. They usually kind of boil it down. They usually don't have you take the sample yourself or anything like that. They usually boil it down to here's the results. Now you have to project it out. Okay. So we have to find out what it is per unit.
Well, I don't think we did 3. Did we do 3?
Oh, all right. We didn't do that one? Oh, okay, let's go ahead.
Yeah, I don't. Oh, we did we? Oh.
Oh, you know what? No, maybe we did. I may have just done that on my own, to be honest with you. So
Oh, okay.
I think you're right. You're right, because this is yeah, because this one has an odd thing that happens with it. Yeah, so this I think I gave this one as homework thing. But this one the so we had a sample size of 5. And so dividing by 5, oops, we got these audit values. And so, at this point, it does, this is at this point, we still have that same amount but it really doesn't tell us what the projected over the entire population is. And this one actually is a little bit of a strained one, and we'll see why in a second. So the average amount, this is, anyone could get this from you're doing your oh, okay. All right, so 5 items. So we have 5 items in the sample. And so just finding the average. So we have 240 and 220. And then the question is, how do we split it up? Oh, you're right, I didn't do the calculations. Okay. So let's make this the first one. I'm going to do something here. Copy this down. I'm just doing this to kind of get it all on one page. Or, close by. Okay, so what we're gonna do is mean per unit, the mean is the average. And I think we talked about this last week, whose average are we gonna look for, the audit or the book? Well, the audit average is considered to be the correct amount. So, we look at the audit value. This is the one that we would consider to be the correct amount. So correct. Another way, and actually the way that they would phrase it for kind of the accounting or the auditing would be that it's more persuasive. Yeah, I spell persuasive right. I usually don't do that. Now, correct amount is maybe a overstatement, but it's the more persuasive of it. It's information that we got for ourselves, not that someone handed us. The company handed us this. But the stuff we looked at ourselves is more persuasive. It's more reliable because we actually went out and figured out that this is what it should have been. Okay, so mean per unit. Mean per unit is, we say we know what our audit value is. The mean is the average. Whose average? Our average, the audit value. And we're going to multiply it. We're going to say, okay. We're going to say, okay, we think that everything in that sample, all 10,000 of these items should be at our average. So what is that? I got it right there, 2.4 million. Forgot what I already had there. So this is the 2.4 million comes from. And so this would be the projected value. So mean per unit, so it says, this is our average. You have 10,000 of these. So every one of those should be at $240. So this is projected value. So we're going to compare that to the value. So total book value is this. Projected value is that, and so the projected misstatement would be the difference. And it says, and this would be an overstatement. They have their book value at 2,500,000. We're saying it should be 2,400,000, so this is an overstatement of 100. Okay, ratio estimation. Let me fill this out a little bit better. You take the ratio of audit over book. If you forget, it's alphabetical. A over B. Times 2,500,000. That 273. Just hit me, that might be wrong. It's
Yeah,
actually
that should be 3. Oh, but
3. I'm sorry about that. So this would also be 3. Okay, so this would be projected value be 2 million. Oops. There's a thing drawing. 2, 7, 3. And if you subtract those, it would be they'd have to take out 200. Now, here's the weird thing. So ratio estimation. Here's the weird thing. I didn't finish writing my numbers. The mean per unit gives you an understatement. The ratio estimation, guess that. An overstatement for the mean per unit, an understatement for the ratio. The ratio said we said it should be higher by 227. So it does make a difference which method you use. Let's see what these look like. And ratio estimation is probably the most theoretically sound one of all of them. And the reason I say that is it has the idea that large items will be up by large amounts and small items will be up by small amounts, and that there's a ratio. You know, that if you have a $50 account, it's probably not going to be off by $1,000. Might be off by $5 or something, but probably not by 1,000. Whereas if you have a $50,000 account, it might be off by 1,000, depending on what went wrong. Big things, big problems; small things, small problems.
Hey, Professor, I had a question real quick.
Sure.
The C, wouldn't that be understated because our our inventory book value was 2,500,000.
Yeah, see, they're saying their books are worth 2,500,000. When we do this projected value, we're saying it's only 2,400,000. So we're saying that they put an extra 100,000 on it.
Oh, I see. Okay, I was looking at it the other way. Okay, thanks.
Yeah, and here's the way to think about this. The projected value, and this is not the terminology that assume that the projected value is the correct amount. And same thing down here. I mean, the same, whenever you come up with a projected value, the assumption is that it's correct because it's you got the numbers yourself and all that. Oops. There we go. So this is the correct amount. Now, if they only have 2,500 on their books, well, let's see it. So we're saying that they should have 22,727,000 on the books. If they only have 2,500,000 on the books, then we're saying that this is understated by whatever it is. So this projected value, the assumption is that that is the correct amount. And this one's kind of a strange one because this one really depends on what method you use. But yeah, and what is material? Is 100,000 material, 227,000 material. That is a judgment call. Debtors estimation, I think, is the hardest one because you got to kind of think about it. Well, which way it goes. And so this audit amount we think is the correct amount. So this would mean that everything down here is overstated. I'm sorry, it is the hardest one. The difference here is everything is understated by 20. So you have to add 20 to every item in there. And this is a weird one because this gives you the projected misstatement. So we get the projected misstatement first. And again, it's understated. The audit amount, this is the amount that we think is the correct amount or more persuasive amount. So we're saying that everything is understated by 20. It should be 240. They only got 220 for their average. We're saying that everything on here has to get $20 added to it. And that makes this part of it a little bit tricky because you kind of back into it. So this is 200,000. Ooh, that's way too much. Hold on. So this would be the projected amount would be. And this is the one that we would consider to be the correct amount. Everything has to get everything on there in their book value has to get 200,000 in total added onto it. 10,000 items, $20 each. And so this would be the correct is maybe a bad term for it, but it's the most persuasive. terminology they would. When it comes to collecting evidence, that's what they would say is more persuasive. Okay. Let's go to number 4. Now, be careful when you do these, be careful of the sample size. If people miss these, a lot of times they miss them because they use 100 items or something like that. So pay close attention. The CPA exam is like this. They'll say a sample size of 60 or 50 or whatever it is. Pay close attention to those because it does make a difference. And this is probably the more common way you'd see it from the CPA exam. Yeah. Oops.
It's $30 and $33.
33.
Yeah.
Okay, so this would be our. I think I'll put it in front of me. I'll put it behind. And again, the audit average, this is the one that we really consider to be the better of the two. Ah. It's fun watching me learn how to use a computer. Okay, so yeah, use that as a green. Okay, so okay, so mean per unit, whose mean are we going to use? Auditor the book. Which one is more persuasive? Hey, you guys are sleeping, right?
The audit,
It's the audit,
Yep.
the audit value of the sample,
Yep, it's more, yeah, this one's more
$30. Oh,
persuasive, and then, actually, I'll do it. And then, yeah, the book value is not as persuasive. So we're gonna use the audit. And so we get this audit average, we say, okay, well, everything should be, you know. Total number of sales, everything, all these sales should be at this average that we came up with.
$600,000.
So this would be our projected value. projected misstatement would be how much?
700,000.
Yep. Okay, so projected misstatement is 100,000, and again, that would be.
Oh, it's 100,000. It's the difference between that. Okay.
What is that, 7? Yeah, so the projected misstatement, and again, this projected value, this is what we would deem as being correct, or maybe more persuasive is probably a better term for it. Okay, is this overstated or understated? They have 700,000 on their books. We think it should be 600,000. Is that an overstatement or an understatement?
It's overstated.
Yep, very good. Oops. Yeah, so that would be an overstatement of 100,000. And again, we can argue about whether that's material or not, but I mean, it probably is. It's quite a bit compared to the 100,000, 700,000 in there. But regardless of that, you know, we're talking about the same numbers. Okay, ratio, and again, ratio is that everything is off. By a ratio. In other words, big things have big problems, small things have small problems. And so we get this ratio and we multiply that times the book value. See, everything is off by the same ratio.
It's 630 divided by times 700,000. It's 636,364.
Okay, yep. Okay, good. So 6, 3, 6, 4. So this will be the projected value, and this is our best. Hey. So this is our best estimate as far as what this is worth. And again, I think this one is probably, for most cases. Kind of the one to go to. $53.36.
Yep.
Boy, does that look funny, doesn't it? Right, so this will be. Okay, so. Is this overstated or understated? So they say it's worth 700,000. Our best guess, not guess, our best estimate is that it is 636,000. So is that overstated or understated?
Overstated.
Yep, good. Okay, now the difference estimation. The difference estimation is kind of the wacky one, and the reason why it's wacky is I doubt it comes into play that much in real life. Difference estimation. Okay, that's not me. It's a calculator. Difference estimation is, it says that everything's off by the same amount. So if you have a $50 account, and it's off by some amount, it'd be the same amount as a $50,000 account. So it's kind of like the, a completely different approach than ratio. Ratio says big things off by big numbers, small things off by small numbers. This one says everything will be off by exactly the same amount. And it's, you say, well, what a wacky thing to say. Well, it's for things that are, if there's a common thing that is off on an account. So for instance, let's say one of the things that's commonly missed are handling charges. They're supposed to charge handling charges on these accounts. And for whatever reason, the handling charges, a $10 handling charge does not get added. Or it gets added in twice or whatever. So it's when there's a possible misstatement on the individual accounts that'll be the same. Okay, so it's sort of like just the opposite of what the ratio one. Ratio one says it varies by rate by how big they are. This one says it doesn't vary. If account's off, it's going to be off by this amount. Okay. So we're going to subtract them. No, over books. So let's give us the difference.
Now, would that be a -3 because it's oh wait. Yeah. Would that be a -3 because
Yeah,
it's an audit? Okay.
And what you'd be saying is, look, you got to take $3 off each of these 20,000 items. Each one of these 20,000 items is $3 too high, so you have to take off $3. This is we assume to be the correct amount. It's a more persuasive amount. So difference here. So we're saying that everything on there has to have $3 come off it. And we're also saying basically that, if there is something off on this, it'll be the same for the accounts, no matter how big the account is or how small it is, it's going to be off by a specified amount. We're going to say that all 20,000 of these have to have 20,000 taken off. And so there's the wacky part. This is the projected misstatement. 50,000. You put a negative in there if you want it.
So is it a negative? Oh, you can just, oh, it doesn't matter.
Well, you gotta, I think a better way maybe is just even to think about it, that we're saying it's worth 30, they're saying it's worth 33, so this is an overstatement. Right? So this is, that's probably the best way to think about it. Another way to think about it is they have to take 60,000 off of the 700,000. But this is the misstatement. Truthfully, I think when they show it in the book, I don't think they even put pluses or minuses. They just say what the difference is in the whole number. But regardless of that, this is a misstatement. It is going to be it's an overstatement. And it's an overstatement because take it off there. It's an overstatement because we're saying that we're 30, they're saying that we're 33. So we say, okay, you have to take $3 off all 20,000 items. And again, this one's a little bit, I don't know, kind of funky because it says everything is off by the same amount. $10 account's going to be off by the same as a $10,000 account. Okay, and it really comes into play when you do this thing. You really have to know which way it goes. But basically, for all of these, if your audit is higher than your book, I shouldn't say for all of these, because on the mean per unit, it could be different. But for these last two, the difference in the ratio one, if the audit is bigger than the book. Let's scratch that. Let me phrase it for this one we have. If the audit is less than the book, it's going to be an overstatement. If it's bigger, it's going to be an understatement. So this is $60,000, and it is, everything is overstated by that. So this should actually be 640,000. And this is the amount that we would assume would be the correct one.
Professor, I have a question. Is the 640,000, is that still a negative or it does not matter?
Well, being that this is an overstatement would just tell you that it's a negative.
Yeah.
Yeah.
Okay.
But yeah, I mean, this one is a little bit wacky. Not
Yeah.
is it wacky? I'm not sure. I did auditing for years, and I can't think of anything that I did that I ever used this one. It is one of the methods, though. It absolutely is, and they can. Basically, for classical sampling, they'll ask you for one of these three methods. A lot of times, they'll give it to you in a multiple choice question. They'll say, "What is the projected misstatement? Overstatement, understatement, that kind of thing." But it is a method that can be used, and basically, you're trying to get something that's small and gets branched out over something that's big. So projected over the entire population.
Okay, that makes sense. Okay.
And just a we go up here where it's a little bit more obvious. Let's go to this one. You gotta realize too, when you're going through these, one thing they'll talk about what's the actual misstatement and what's the projected misstatement. So I'm going back to number 3. The actual misstatement for number 3 would be, for the items that we took, the actual misstatement would be $100. And even if you didn't, if you didn't decide that this was a problem, whatever you did down here, you might still, let them know, oh, by the way, these accounts are misstated, you may want to correct those, whatever it is. But so here we have the actual misstatement, it's only $100, but you come down here and the projected misstatement can be much more than that, because you're taking it and projecting it over the entire population. So there is a difference between the actual misstatement and the projected one. And the projected one is what we really want to use, because this is only over 5 items, this actual misstatement. Okay, I think let's do this. I'll leave number 5 to you guys, and you can turn it in, and I will change the due date on this to the 16th. If you have any questions on it, I can go over it next week. But I'll put that in for the 16th, for the classical sampling. And what I want to do is come down here to this last one, number 6. So we'll do number 6 right now, and then you can do number 5 on your own and turn it in. You can, and if you're unsure if you got the right numbers, you can go ahead and ask me. Which estimation of classical sampling is the best? It depends. Mean per unit. Mean per unit is the best if all of the items in the population have similar values. So mean per unit is best if all the items in the population have similar values. So, if they're all like $5,000 or $6,000 or something like that, it's a good one to use. I'll give you another. I have no idea when this would come about, but another time that people say use this one is if the book value is unknown. because it doesn't use the book value. Let's go to, you'll notice that this only uses the audit average, it doesn't use the book average, only the audit average is used. So let's say you run into a situation where you had a company that, you can't depend on their records at all. You don't know what the book value is, you can't trust it for anything. It might be good to use a mean per unit one just because you don't have to know what the book value is. So if the book value really is unknown, now remember they got their financial statements out. The book value really is unknown, you're kind of left with this one. This is the only one that you can use. Because it does not use. Oops. It's not use book value in the calculation. So you start looking at their books and they got crazy numbers on there. You can't figure out how you did it even. This is one you can use. Ratio estimation. Larger items. So ratio estimation is best when the population varies. If the population is all the same, mean per unit's a good one. Let's say it isn't the same. You have $50 accounts, you have $50,000 accounts. It's good when the population varies, and larger items will have larger errors than smaller items. So, in other words, there's a ratio of the errors. The big things, big errors, small things, smaller. My guess is that this is going to fall into most things. When I was doing auditing, this is the one that we would use for most things. I may have used this one for something. I can't remember, to be honest with you. Things like engine block. We made engines, so things like engine blocks would all go out the same. Yes, you can do easy for that. Okay. Yeah. So ratio estimation, and I get my own personal feeling is probably the. I don't know that for a fact, but my guess would be that most populations don't do this. Mean per unit is for things that are like the safe side. And by the way, all these you can use them for a lot of different things. So mean per unit, if you want to know how many pounds of ducks there are on the lake, you could take 10 ducks and weigh them, and they're probably all around the same weight. Okay, take 10 ducks and there's 230 ducks on, you could figure it out. But the ratio one is probably the one that I think especially for financial stuff, is probably the most common. And difference estimation is used when all items are likely to be misstated by the same amount. So there's something that is period. That there's something is, whatever it is, they'll be off on a $50 account or a $2,000 account, that there's something that's missing that should be put on there. If it's misstated, it'll be misstated the same for all items. So it really, and by the way, the AICPA does not come out and say which one they prefer. They say, they'll tell you, in different circumstances, different things that are appropriate. Okay, so do number 5, this will be for homework. And again, next week, if you have questions on it, maybe I'll just flash up on the screen next week. If you have any questions on it. So, by the way, I think I told you guys this before. So this will be, I'll put the, I think the drop already in. If the drop's already in. Nope. Oh, wait, yeah. Let me change this right now. Right now, while we're here, so we can ensure that it's done. We're doing the 16th. So yeah, do the last one, number 5, and then you can submit it there. And I think I told you guys this last week. If I did, I should have. That just because there are due dates, that's the date that's going to show up in your grades. Doesn't mean that you can't turn it in after that date. You can. It's just you won't have a grade for that until you turn it in. So your grade's going to look bad because I'm going to include that column in your grades. So if you don't get it in, yeah, your grade's gonna be low because it's not in. But when you turn it in, your grades will jump back up. And I don't take off anything for being late. Now, I strongly encourage you not to get behind just because you generally do better for it. You don't want to risk it. But so the due dates, don't get too crazy about the due dates. If you can't get it written right on time, get it in as soon as you can, and you'll still get full credit for it. Any question on that? Okay, well, and if you work through the problem and you want to know if you get you're not sure on your answers, go ahead and email me and I'll, see what you got and say yes or no. And then, but then you turn it in, and again, the grades will be after that date. This is our first thing we're turning in. After the 16th, that'll be our first thing that will be in our graded date. Any questions? Just had enough water, Dean?
Mhm.
Okay, all right. Have a good evening, and I'll see you guys in a week's time.
All right, thank you. Bye-bye.
Thanks, guys.